Hello and welcome to the Commercial Real Estate Talk Podcast. This is episode 127, Office Sector Woes, Part 6. That's right. We've spent 5 episodes here recently talking about the demise of the office sector. But we're not done yet because this is Part 6, and most of the recent news has to do with office. It's making national news. It's all over the place. What's going to happen with office? Everyone keeps working from home. Do we need offices any longer? That's what people want to know. But welcome to the podcast. If you're new to the channel, listen, if you haven't visited yet, let me make a plug here for the Commercial Real Estate Talk channel. There it is on the podcast. And by the way, these podcasts are now on YouTube, and you can follow us along if you want to hear and see the podcast live. It might be helpful from time to time. There's charts, there's articles we talk about. But I've got a beautiful picture of the Commercial Real Estate Talk channel on YouTube. Please subscribe. We are now putting out, as well as this podcast, some shorts, and we're about 5 deep now. And the subjects are flight to quality, parking ratio, ROFO, cap rate, TI. I've got a list of 50, 60 of these that I wrote down. I'm answering them, trying to bring you commercial real estate tips and know-how in under a minute. That's the purpose of the shorts. And so far, praise God, it looks like they're being well received. Folks are learning commercial real estate in under a minute, and we're going to try to pump out at least 2 per week. I'm going to try shooting for Mondays and Fridays, kind of bookend the week with these shorts, and then this podcast on Thursday. So that's the intent of this channel. Look for things to come, God willing. We'll include maybe an in-between, because these podcasts go about 30, 40 minutes when we talk about commercial real estate news. But in between, we're looking to do a little deeper dive teaching series on commercial real estate concepts and themes, formulas, and so forth. And that I'll probably ask for about 5 minutes of your time to do that. We're trying to ramp up the surrounding studio here, and so stay tuned. So, case in point, please subscribe, because you never know when something new is going to come from the Commercial Real Estate Talk channel. And that's what we're about. We're trying to dispense commercial real estate knowledge to help your business. We track commercial real estate so you can focus on your business. Let's jump right into the podcast. And article number 1, this comes from Crain's New York Business, which, by the way, I would love to tell you more about this article, but Crain's New York Business somehow wants you to pay for a subscription to dive into stuff that's publicly published everywhere else. So not sure that's a long-standing business model for Crain's New York, but here this article tells us new office leases average 14% smaller, J.P. Morgan Chase says. Now, in this case, the headline is everything you need to know. There's a beautiful picture of Manhattan. There's always, of course, the Empire State Building that defines the skyline. Office tenants are taking an average of 14% less space than before the pandemic, and more than half the leases signed before 2020 have yet to come up for renewal, a combination that threatens to keep vacancy rates elevated into 2027. That's 3 years from now, and that's exactly what we're seeing now. 14%, that's not what I'm saying. I'm saying it's double that. I'm saying 30 to 40% is what the corporate world is saying. We have too much space. So if I had 10,000 feet, I only need 6 or 7 today. 14% is not that big of a deal. 30% it gets into big deal territory. But according to JP Morgan Chase, and again, I'm not sure what metrics they're using, because thank you, Crain's New York Business. To continue reading, you got to be a paid subscription provider. So that's just a little teaser there. But this highlights where we're going, and we only have 2 or 3 articles to talk about. We're going to try to value your time today. We always value your time, but we're going to try to really jump right in. Well, along with the bad news on leasing, and what's the domino effect of this? Again, tenants are taking less space. Whether it's 14, 30%, it's probably going to vary per market. But that's because folks are working from home. The corporate world is starting to adjust. Half the leases signed before the pandemic have yet to expire. Again, in commercial real estate, leases are usually 5-year minimums, up to 10 years. In some cases, for larger deals, they go 15 or 20. Those leases that were signed in 2019 are now starting to expire. Those leases that were signed in early 20 or throughout the pandemic or into 21 are going to be expiring the next few years. 7-year deals signed in 18 have yet to expire. A 10-year deal signed in 2015. Think about that. 2015, President Obama was president. Those leases have yet to expire. The world has changed. Commercial real estate has changed. And so all that's coming through the pike. And the expectation is corporate world's going to give up space, whether it's 14, 30%. But look at what that affects. It's going to obviously affect the property owner, right? Because they're going to have less occupancy. That's going to affect the restaurant who's down there on the first floor, the little cafe who depends on a full building in order to provide sandwiches and coffee and so forth, and all the surrounding businesses that are built around a hub of professionals coming in and fully occupied downtowns and CBDs. And so it's a trickle-down effect. Kevin O'Leary recently talked about retail and how we're seeing it in urban areas, restaurants closing left and right because they signed long 5-10-year leases to open up a Starbucks, to open up a coffee shop in downtowns, expecting that there'd be 1,000 people working at that building, and you shave off 30-40%, but in some cases it's only 50-58% occupancy of folks actually coming back to the office, and you can no longer pay the rent that you agreed to pay when you sign that deal because you don't have the traffic, you don't have the sales. So it's a domino effect that's boiling through the commercial real estate, but it's starting here with office. And the fact that folks are just not returning to the office as quickly as the industry needs it. The next article is from BizNow. And listen, what's happening in the U.S. is being paid attention to. And I've got some thoughts around the world. And this article is entitled Foreign Investments in U.S. CRE, Commercial Real Estate, Tumbles to Lowest Point Since 2011. Foreign investments in commercial real estate in the United States has tumbled since the lowest point since 2011. What happened in 2011? We were coming off the Great Recession, right? There was pretty much a collapse in commercial real estate. I was at $50 in one week. The next year, we're happy to get $34 for Class A space on Brickell. Now, that building, incidentally, is quoting about 110, 120 today. So the market rebounded. But let's get into this article. Interest from international investors in commercial real estate assets in the U.S. fell by almost half in just 1 year as the slump in prices and transaction activity has taken its toll on cross-border investments. I have maybe a little twist to that we can add. Foreign investors spent $14 billion on U.S. commercial properties in the first 3 months of the year, according to MSCI Real Assets data provided to BizNow, down from $27.7 billion in the first quarter of 2023. So about 50%, right? They spent almost $28 billion last year in the first quarter. This year it's only $14 billion. The last time international investors spent that little money on commercial real estate in the U.S. was Q3 2011. The nosedive in foreign investments mirrors the moribund investment market overall, as owners have demonstrated a continued reluctance to sell while valuations are low and borrowing costs are high. If I'm the current owner and I'm thinking about selling, I think to myself, well, rates might be a bit lower in the future. I might be getting a better deal in the near future. Jim Costello, chief economist of MSCI Real Assets, said in an interview, so unless somebody forces me to, I'm not going to sell. Some of the pullback has been from investors in the Asia-Pacific region, with some expressing more interest in investing in U.S. debt funds than directly buying property, Castillo said. So what does that mean is if you can get a U.S. Treasury, I haven't checked the rates, but let's say it's north of 5%, why would you jump into a risky real estate deal in this environment to try to get 5% or 6% of cap rate in return? So you have a lot of dynamics coming into play here. Even in slower markets, international investors are still acquiring a historically low share of properties, making up just 6% of the overall volume in the first quarter, according to MSCI. Just the second time, 2009, shares have fallen. Now, I don't know if you can hear what's going on in the background, but my little canine assistant is just barking up a storm because our neighbors are walking their dog. So she wants to be out there and close deals. And so anyhow, hopefully that wasn't too much of a distraction. Even in slower markets, the past 2 years, the most consistently active investors outside of perennial leader Canada hailed from Singapore and Japan. Singaporean investors have bought $2.7 billion worth of commercial properties in the past 4 quarters, with Japanese buyers invested $2.3 billion. So think Sumitomo and China, right? Sumitomo is a big owner of commercial real estate down here. Even in Miami, they own a large office tower. Some of the strong activity for Japan is due to the yen's recent weakening, Cushman & Wakefield Global Placement Director said. So one reason is Japan's yen compared to the dollar has weakened. So that makes U.S. money even more expensive. Than you add on top of that the interest rates, and it's a double whammy. A few years ago, they, meaning Japan, bought deals in the U.S. It now seems like it's performing even better because of the exchange rate difference now. So it seems like they're making more money on those deals, she said. That also led to more positive view of commercial real estate market in the U.S. compared to foreign investors' domestic market, she said, but they also are hunting for bargains before prices start to rise, sentiment that is also motivating European investors, which is the only group looking at office assets in the U.S. She added, I think now is a downtime for the U.S. Let's see here. So she cites a few examples. A French parent company looking at something in Manhattan. We got a Spanish billionaire, Amancio Ortega, acquiring an asset in Chicago. Many European investors are trying to capitalize on assets at the low point. So what's happening is Europe is still buying. Europe is kicking tires. They're looking at saying, okay, office is pretty low right now. They're in the doldrums in the United States. Now would be a good time to get some strategic assets on our books. Now, the article kind of continues, as you see, but I want to shift gears a little bit because, look, they mentioned that Asia Pacific is not buying. You know who else has been a major buyer of real estate in the U.S. is two countries that they don't talk about. If you live in South Florida, you know these two, China and Russia. Russia has, in fact, Oko Group is a Russian group, and they are the developer behind 830 Brickell Plaza, the most successful pre-leasing office story in America over the last 4 years since the pandemic. We're talking over 600,000 foot Class A tower, charging upwards of $200 a square foot. Now, I can't find the article, but this week we posted a reminder, connect with us on LinkedIn, on Blue Box Real Estate corporate page, so you can get all these articles fished through you. Also, the shorts and podcasts that we're doing are appearing on the Commercial Real Estate Talk channel, which was formerly the Don't Sign the Lease. We'll talk about that later. But you got two ways to connect with us on LinkedIn if you want to see articles and what we're doing. Oko Group, Russian group, developed 830 Brickell, $200 a square foot Citadel. Ken Griffin's group just took another 2 floors. Now, if you're like me, you've been tracking this building since it started. It seems like they're just inventing floors because every time I check, that building is fully leased or has only 1 floor to lease, and then all of a sudden I hear somebody else is leasing multiple floors. So I don't know where the floors are coming from. They're I guess building them out, maybe adding, I don't know. But Citadel's taking 2 more floors, and again, the price tag that was quoted on those were $200 a square foot. I have heard deals signed at $180 and north on Brickell outside of that building. So that's where real estate is for commercial real estate office price per square foot. So you think you have it bad when you get your renewal from the landlord? Think of the Brickell tenants getting $180 to $200 a square foot. But that's a Russian group. And they've announced they've got another project they're working on elsewhere in South Florida. So yeah, in South Florida, we know that Russia and China are very active investors in commercial real estate. Well, I don't know. Maybe there's another reason why Russia investment has been slowed down in the U.S. and maybe China and maybe Brazil and maybe India. Maybe the BRIC countries have decided, their investors, that they're not going to invest so much in Russia. Well, let me tell you, I got to believe the article doesn't go into that, but it did hint Asia Pacific, which is China. Look, there's been a lot happening in the news, and this isn't a political channel nonetheless. We're going to look at it from the angle of commercial real estate. Why would Russians and Chinese and some other foreign investors, anybody outside of Europe essentially, we're not seeing a lot of investments from South America. It's primarily Spain and France. Okay, these are all kind of in good graces with the United States, but here's what our foreign policy is starting to impact our domestic policy, right? Our investments here. You know, to do transactions, you got to do them in dollars. And I don't know if you all been watching this whole Saudi Arabia. The petrodollar expired June 9th, and they didn't renew it, which means now the world can trade in any other currency that Saudi Arabia wishes, not just U.S. dollars. That's gonna impact our economy somehow. We're gonna figure out how that works out. But you know what's going on? We keep sanctioning countries, right? We're sanctioning Iran, we sanction Russia, we sanction here, we sanction there. And we're freezing assets, we're taking people's money, and we're using the interest, and we're starting to spend it, and we're seizing properties. And you do that enough times, and people are going to say, well, you know what? I don't trust the government. I don't trust I'm not going to go spend billions of dollars in buying real estate in America, because if all of a sudden we're at odds in some area, they're going to freeze my assets and they're going to freeze my accounts. And I got to believe that that's putting some hamper in foreign investments into the U.S. I don't think it's just coincidence that only Europe, who's in good graces with the United States, is still looking to kick the tires and invest in real estate. Meanwhile, Asia Pacific, China, and Russia have fallen off the map, and South America, they're like saying, oh, maybe we'll slow down our investments in the United States a little bit, because if things get a little hairy there politically, we may be in danger of being sanctioned or having our assets frozen or our accounts frozen, and we can't draw our money out or have it stolen. Again, speaking from their view. So I got to believe that our foreign policy and these sanctions are coming back to roost a little bit in the first quarter, with money kind of being pulled back and things being questioned. So let's track that long term. I hope I'm wrong. I hope it's just, people are investing in U.S. T-bills instead of hard assets. I hope it's not because there's wars everywhere and we're sanctioning so many that folks are drawing back, saying, do we really want to do this? Because the purse is in their hands and they can determine what to do with it, and that's too much power. So we'll see. We'll see where that goes. But that's kind of my little twist, right, to why foreign investments in the U.S. are tumbling to the lowest point since 2011. Why now? Why now? And why is it coincidental that only Europe is interested in buying U.S.? You give me a comment down below. You give me a comment. Let me hear what you think. That was kind of one of my thoughts. All right, so we talked about new office leases are coming down. Look, we're down to the last article that I really want to highlight, which is why, again, all these have to do with office, essentially. Office sector woes, part 6. Globe Street. Does CRE have a stagflation problem? CoStar Group seems to think so. By now, if you've been a loyal listener, you know who CoStar Group is. But if you're new to the channel, CoStar Group is the foremost research, data, analytics, market data for commercial real estate. You can't be in commercial real estate and not be touching CoStar, right? That's like the MLS. What the MLS is for residential real estate, CoStar is for commercial real estate. And then, they also own LoopNet, by the way, and a couple others. So you might be touching them and not even realize it. But according to CoStar, stagflation is a real problem. Here goes the article. There's no official body or organization that formally declares when the U.S. economy enters a period of stagflation. That is, an economy characterized by slow economic growth, high unemployment, and high inflation occurring simultaneously. So let's look at that. Slow economic growth, high unemployment, and high inflation all coming together. That's a problem, right? I mean, I don't have to tell you that. It's a big problem. Now it's highly debatable whether the U.S. economy is suffering from these conditions and may in the near future. However, a growing number of observers believe CRE, commercial real estate specifically, has a problem with it, including most recently CoStar Group. It notes that the current rise in borrowing costs, interest rates, coincides with significant slowdown in income growth across most property sectors, as property incomes peaked at 8.4% year over year in the first quarter of 2022, but have since tumbled 3.6% in the first quarter in 2024. The current stark reduction in property income signals stagnation inside commercial real estate, with sluggish income growth averaging 3.6% across all sectors, barely outpacing headline inflation rate of 3.4% in April of 2024. Now, I'm assuming that's an average. He's talking about all the sectors. If you can go to office, listen, there's some markets that it's not that there's just slow growth that's not keeping up with inflation. We are at that point where we're going to start seeing rates come down in some key markets. And if you're here in South Florida, I'm thinking of Doral, right? There's buildings that are vacant. You got to think there's only a matter of time till rates start to inch downward. You're thinking if you're in Broward, perhaps Southwest Broward, Sunrise, you've got, again, buildings that are vacant. West Cypress Creek Market, again, perhaps buildings and floor plates that are vacant and have been vacant. And how long can a landlord hold on? And that's probably another podcast. Why do landlords hold on so long? That's probably worth a short. Why landlords don't lower their rates quick enough when the space is vacant. You would think that, hey, I asked for 30, I can't get it. How about 20? Can't get it. How about 15? Just get anything. But that's not how commercial real estate functions. But they're calling stagflation because they're not keeping pace. The annual growth is not keeping pace with inflation. But in some markets, it's worse than that. Income growth is negative. So it's a double whammy, right? Inflation's coming up here, and rental rates income growth is coming down here. So the bridge is going to be a lot bigger. Let's keep going. But while commercial real estate may be struggling with stagflationary elements, the current U.S. economy does not reflect at all conditions seen in the 1970s when stagflation was widely seen as rampant. Then inflation reached staggering levels with consumer price index peaking at 14.8% in 1974. Could you imagine that? 14.8%. You know, the dollar store next year's $1.15. Anyway, and remaining in double digits until 1982. Also, real GDP declined in 1974 and 1975, while current data suggests a slowdown in growth. An outright contradiction is unlikely. But with the economy as uncertain as it is, worries abound that it may enter a period of stagflation. In an interview in April, Associated Press, J.P. Morgan Chase CEO Jamie Dimon said he was hopeful the Federal Reserve can bring down inflation without causing a recession, but wouldn't rule out stagflation. You should be worried about it. The possibility of stagflation, Dimon said. A month prior to that, strategists from Bank of America wrote the macroeconomic picture is flipping with Goldilocks to stagflation, which they defined as growth between 2% and inflation between 3 and 4%. Inflation is higher in developed emerging markets, while the U.S. labor market is finally cracking, Michael Hartnett said. Now, look, someone needs to explain to me why stagflation or deflation. I guess stagflation and deflation are two different things, but at some level, it's okay for the consumer, right, if prices come down. It's not good for the developers or the property owners, but at some point, if the income growth isn't there for property owners and they lower rates, that's good for the end tenant. It's good for the consumer, not good for the property owner. Same thing with and anything, cars. Look what's going on with cars. From my understanding, there's got a glut of cars right now, and prices might be coming down. Bad for the car companies, good for the consumer. So it depends on which angle you look at it. And but we're going to have to track this, and that's 3 articles today. New office leases are getting smaller. Tenants are renewing. They need not as much space. Foreign investments pulling back from commercial real estate. You let me know why you think only Europe is interested and Russia and China and other countries are pulling back. Is it just because the interest rates, or are there other reasons? And then is commercial real estate entering a stagflation? We're seeing income growth fall. So that's it for the podcast. I don't know what happened to my screen. I hope you can still see me. There you are. Maybe remind you, again, if you haven't, go to, for now, don'tsignthelease.com/book if you want to get a copy of the book, Commercial Real Estate Office Leasing. Now, stay tuned. We got some major announcement. This website's going to get updated. We're moving away, for branding purposes, away from the Don't Sign the Lease concept, away from this logo here, and more towards commercial real estate talk, commercial real estate help. And so stay tuned for that. I expect that to be done the next week or two. But for now, this is where you can find all our resources. There'll be a redirect to the new. It's going to pretty much be the same, just with different branding. And then, please, if you haven't already, help us out. Go check out the shorts. Learn commercial real estate in under 1 minute. Look, we've got 600, 400 views, praise the Lord, and we got 31 subscribers. So we need a little more commitment, subscribers. We need help to show how. Go there, enjoy, learn, and subscribe so we can keep producing some good content. And again, we got some good stuff coming in the future. In fact, here's a little sneak peek. God willing, the plan is tomorrow to do a short on what is USF. And I'm going to leave that into you so you can chew on it all night and go in tomorrow and look forward to the next short. What is USF? We're going to break that down for you. Again, hopefully make this digestible so you can actually walk away with something that's actionable, that's tangible, you learn, you can apply, and it's going to help you and your business out. And if you're considering jumping into commercial real estate, or you know a realtor who dabbles in commercial real estate, we're hoping that these shorts can also hit a little nice place there where folks can learn quickly. And so that's it for the show. Thanks for tuning in to episode 127, Office Sector Woes. We'll keep tracking this for you. Remember, Proverbs 20:18, plans are established by counsel, by wise counsel, wage war. Thank you. We do appreciate and value your time. Good day.